Andy Schectman just revealed something the institutions pray you'll never figure out. When silver crosses $100, when gold reaches $5,000, there's a 72-hour window. A window where fortunes either multiply or vanish completely. The decision you make in those 72 hours will determine whether you're among the few who profit or the many who panic. What Schectman disclosed about this critical moment changes everything you thought you knew about precious metals exits. But here's what nobody's telling you. Welcome to Currency Archive. Now, if you've been in the markets long enough to remember when a handshake meant something, when financial advice came from experience, not algorithms, then you know the value of real intelligence. Do me a favor, hit that subscribe button. Because what we discuss here isn't for the crowd chasing overnight riches. This is for those of you who understand that wealth preservation is a chess game, not a lottery ticket. And before we dive into Schectman's revelation, drop a comment below. Where are you watching from today? New York, Texas, maybe somewhere overseas? I'm curious to know where serious investors like yourself are tuning in from. Now, let's talk about what happens when those price targets finally hit. When Andy Schectman appeared on Thoughtful Money's live stream in early 2026, the precious metals market was experiencing something unprecedented. The host asked the question that was on everyone's mind. Should investors sell now that these remarkable price levels had been reached? After all, silver had climbed from the high 60s to over $90 in what seemed like weeks. The magnetic pull of $100 silver felt almost inevitable. Gold's march toward $5,000 seemed equally unstoppable. Schectman's response was direct. This wasn't the time to sell, not even close. But his reasoning had nothing to do with technical charts or price predictions. Instead, he pointed to something the mainstream financial media was completely ignoring. In December alone, the COMEX market had witnessed the largest silver delivery in its entire history, 68 million ounces. Then January, which wasn't even a scheduled delivery month, saw another 40 million ounces delivered. That was 110 million ounces in just 40 days. These weren't retail investors buying a few coins. These were the most well-informed and well-funded traders on the planet standing for physical delivery. Central banks, commercial banks, sovereign wealth funds, possibly even major corporations like Tesla and Samsung. These entities were converting paper contracts into physical metal at an unprecedented rate. The silence surrounding these deliveries was deafening. While gold and silver had crushed the S&P 500's returns during the greatest tech boom in history, not a single mainstream outlet was discussing what was happening in the delivery markets. The largest wealth transfers in precious metals history were occurring in plain sight. Yet financial advisors across America were still telling their clients that gold and silver were speculative distractions. Schectman explained a critical concept that separated this moment from previous price surges. Gold and silver had never been allowed to reach true price discovery. For decades, the prices had been suppressed through paper markets, futures contracts, and financial engineering. The current price action wasn't just a rally, it was the beginning of a repricing. The evidence was everywhere for those willing to look. The Shanghai Precious Metals Exchange was pricing silver $8 to $10 above Western spot prices. This massive arbitrage opportunity wasn't closing because traders were deliberately keeping it open. They would buy paper contracts in the West, stand for delivery, ship the physical metal to Hong Kong, then truck it to Shanghai, where they could sell it for significantly more. The Chinese market was screaming that silver was worth far more than its paper price suggested. Lease rates were spiking, spreads were widening. These were classic signals of tightness in the physical market. When the COMEX raised margin requirements by 30% the day after Christmas, from $21,000 to $27,000 per contract, it was supposed to flush out leveraged traders. That's what had worked in 2011 to kill the previous silver rally. But this time, the strategy failed. The entities standing for delivery weren't using margin. They were paying cash. They had no need to sell when margin calls came. These were sovereign nations, central banks, and institutions with essentially unlimited capital. They weren't speculating. They were accumulating strategic assets. This was the fundamental difference between 2026 and every previous precious metal cycle. In 1980, the Hunt brothers tried to corner the silver market through speculation and leverage. In 2011, retail traders and hedge funds piled in, only to be shaken out when the exchanges changed the rules. But now in 2026, the buyers were nations competing for finite supplies of critical materials needed to build advanced civilizations. When TD Bank publicly announced they were shorting silver, expecting a devilish blow-off top with a target price of $40, they set their stop loss at $92. Within days, they were stopped out. The bank had expected to engineer a reversal using the old playbook. It didn't work. The market had fundamentally changed. Schectman referenced rumors that the 5 major U.S. banks that had held massive short positions for years had flipped to long positions. If true, this meant American financial institutions had finally recognized what the rest of the world already knew. The paper game was ending. Physical metal was being repriced, and those caught on the wrong side would face catastrophic losses. The question wasn't whether silver would hit $100 or gold would reach $5,000. The question was understanding what those milestones actually meant. Were they the end of the rally, or merely waypoints on a much longer journey toward true price discovery? For the institutions quietly accumulating millions of ounces every month, the answer was obvious. They weren't buying because prices had gone up. They were buying because prices were still far too low. The financial world operates on unspoken rules that most investors never see. For decades, these rules governed how precious metals were traded, suppressed, and controlled. But in early 2026, something extraordinary was happening. The institutions that had written these rules were now breaking them. Andy Schectman had spent over 3 decades studying institutional behavior in the metals markets. What he was witnessing in real time was a complete reversal of everything that had defined precious metals trading for generations. The old playbook was being torn up, page by page, and replaced with something entirely different. When institutions prepare to exit a market, they follow predictable patterns. Staged selling, derivative hedging, converting physical holdings into paper positions to maintain exposure while reducing actual metal ownership. Wall Street had perfected these strategies over decades. Every major commodity cycle followed the same script. But the current delivery data told a completely different story. Major financial institutions weren't selling, they were buying. Not just buying paper contracts for speculation, but standing for actual physical delivery in quantities that defied conventional market logic. This wasn't profit-taking behavior. This was accumulation on a scale that suggested these institutions knew something fundamental had changed. The 2011 silver rally provided an important comparison point. When silver approached $50 per ounce that year, institutional traders used leverage and speculation to drive prices higher. The COMEX exchanges responded by raising margin requirements repeatedly, forcing leverage traders to liquidate positions. Within weeks, silver had collapsed back to the low 30s. The institutional playbook had worked perfectly. Fast forward to 2026, and the same tactics were being deployed. Margin requirements jumped 30% overnight. Financial media outlets began publishing bearish forecasts predicting dramatic reversals. Major banks publicly announced short positions, expecting history to repeat itself. Except this time, the market didn't break. The entities driving demand in 2026 weren't using leverage. They weren't speculating on short-term price movements. Commercial trader commitment reports showed something unprecedented. The traditional short positions held by bullion banks were shrinking, while long positions were growing. Some analysis suggested that all 5 major U.S. banks that had maintained massive short positions for years had not only covered those shorts, but had actually flipped to long positions. If accurate, this represented one of the most significant strategic repositioning events in financial market history. JP Morgan alone had reportedly covered a 200 million ounce short position and had been accumulating physical metal for months. But the very institutions that had suppressed precious metals prices for decades were now positioned to profit from rising prices. This shift exposed the European bullion banks, particularly those operating through the London Bullion Market Association. While American banks were covering shorts and going long, European institutions remained trapped on the wrong side of the trade. The LBMA, which claimed to have 700 to 800 million ounces of silver in storage, faced a critical vulnerability. David Jensen, an expert on LBMA operations, had been warning about this for months. Of the reported silver inventory, the majority belonged to ETFs like SLV and private storage programs. That metal wasn't available for delivery against contracts. The actual free float, the silver that could be delivered against outstanding paper contracts, was estimated at only 140 million ounces. Against that 140 million ounce float stood approximately 2 billion ounces worth of paper contracts. The leverage ratio was staggering. It was a house of cards built on the assumption that most contract holders would never demand physical delivery. That assumption was now being challenged daily. Throughout 2025, the LBMA had quietly extended settlement times from T+1, next day delivery, to T+8 weeks. The official explanation blamed logistics, insufficient manpower, limited trucking capacity, administrative delays. But market observers recognized the truth. The LBMA couldn't deliver metal it didn't have. The 8-week delay was a desperate attempt to buy time while scrambling to source physical silver. Sovereign wealth funds understood exactly what was happening. They could see the delivery failures coming, so they accelerated their accumulation strategies, requesting physical delivery on every contract, knowing that each delivery request tightened the noose around the institutions that had sold metal they did not possess. China was playing this game with particular sophistication. By maintaining Shanghai exchange prices $8, $12 above Western spot prices, they created a permanent arbitrage opportunity. Traders would buy COMEX contracts, stand for delivery in Hong Kong through specialized COMEX facilities, then truck the metal across the border to Shanghai for immediate resale at higher prices. This arbitrage wasn't closing the price gap because that wasn't the goal. The goal was to drain physical metal from Western vaults as quickly as possible, while using America as trade surplus dollars to fund the operation. Every ounce that moved from New York or London to Shanghai was an ounce that would never return. The institutional playbook had always relied on one critical assumption: that the game could continue indefinitely as long as most players accepted paper claims as equivalent to physical metal. But when sovereign nations began demanding physical delivery at scale, that assumption collapsed. Bear Stearns had learned this lesson in 2008. According to Bart Chilton, former head of the CFTC, Bear Stearns had gone bankrupt partly because silver reached $21 and they couldn't cover their short position. JP Morgan had absorbed Bear Stearns to prevent a catastrophic default. Now, in 2026, the same dynamic was playing out on a much larger scale, except this time there might not be a bigger bank willing or able to absorb the failures. The contagion risk wasn't limited to precious metals markets. Major financial institutions were interconnected across equities, forex, interest rates, and countless derivatives. A failure to deliver in the silver market could trigger margin calls and redemptions across every asset class a bank touched. The institutions accumulating physical metal understood this risk perfectly. They were not preparing for silver to hit 100. They were preparing for the moment when the paper market failed entirely and true price discovery finally began. Every investor faces critical decision points in their lifetime, moments when conventional wisdom points one direction while opportunity pulls in another. The question facing precious metals holders in early 2026 was deceptively simple. When silver crosses $100 and gold breaches $5,000, what comes next? But Andy Schectman insisted this was the wrong question entirely. The real question wasn't about price levels. It was about understanding which side of history an investor was positioned on. Because what looked like a simple buy or sell decision was actually a test of whether someone understood the fundamental transformation happening in global markets. Schectman had developed a framework for evaluating threshold moments in precious metals, not based on technical analysis or chart patterns, but on three quantifiable factors that revealed the true nature of any price move. These factors determined whether a price threshold represented a bubble top or a beginning point. The first factor was physical market structure. Not the paper price on exchange screens, but the reality of metal availability. Premiums over spot price told the story. When premiums contracted while paper prices rose, it signaled distribution, institutions selling into strength. But when premiums expanded, even as prices climbed, it revealed genuine scarcity. Physical buyers were willing to pay more than futures prices because they understood paper contracts were becoming increasingly unreliable. In early 2026, premiums were exploding. Silver Eagles that historically traded $2 or $3 over spot were commanding $8, $12 premiums during peak demand periods. Delivery times from major refineries had stretched from days to weeks, then from weeks to months. Refineries were running at maximum capacity, yet falling further behind on orders. This wasn't normal market behavior. In healthy markets, rising prices incentivize increased production and shrinking premiums as supply catches up with demand. The opposite was occurring. Higher prices were revealing deeper scarcity. The second factor was institutional positioning. Where were the largest, most informed players placing their bets? Commercial trader commitment reports provided some visibility, but the real intelligence came from delivery data. Who was standing for physical delivery, and in what quantities? The pattern was unmistakable. Month after month, delivery requests were breaking records. These weren't short-term traders flipping contracts. These were long-term holders converting paper promises into physical assets. The composition of buyers mattered enormously. Hedge funds and speculators could be shaken out with margin increases or negative news cycles, but sovereign wealth funds and central banks operated on entirely different timelines. When a nation decides gold or silver is strategically important, price becomes almost irrelevant. They're not trying to optimize entries and exits. They're securing resources they've determined are critical for long-term national interests. Once that determination is made, accumulation continues regardless of price fluctuations. The third factor was monetary policy trajectory. Not just current interest rates, but the mathematical reality of government debt levels. The United States was running deficits that couldn't be sustained without currency debasement. Real interest rates, nominal rates minus inflation, were the key metric. When real rates were positive, holding cash made sense. Savers earned returns above inflation. But when real rates turned negative, cash became a melting ice cube. Every year of negative real rates transferred wealth from savers to borrowers, from citizens to governments drowning in debt. Central banks worldwide were trapped. They couldn't raise rates enough to achieve positive real returns without triggering economic collapse and government defaults. So they chose the slow debasement path. And they quietly bought gold to protect their own reserves from the currency destruction they were engineering. These three factors created a decision matrix. When all three aligned in one direction, the correct strategic response became clear. Schectman outlined two possible scenarios for what would happen when silver hit $100. Scenario A was the distribution environment. Physical premiums would contract as large holders sold into strength. Paper open interest would increase as speculators piled in at the top. Institutional delivery requests would slow. In this scenario, $100 silver would mark a major top, similar to 1980 when the Hunt Brothers corner collapsed, or 2011 when leverage-driven speculation unwound. The appropriate response to Scenario A was staged profit-taking, not panic selling, but methodical reduction of positions while maintaining core holdings. Rotate some gains into income-producing assets or undervalued sectors. Keep powder dry for the next accumulation opportunity. But Scenario A required specific conditions. It required that the current move was driven primarily by speculation rather than structural scarcity. It required that institutional players were sellers rather than buyers. It required that monetary policy was tightening rather than loosening. None of those conditions existed in early 2026. Instead, every indicator pointed towards Scenario B, the accumulation environment. Physical premiums were expanding, not contracting. Available inventory was declining despite higher prices. Sovereign accumulation was accelerating. Central banks were buying gold at record pace while keeping interest rates suppressed. In Scenario B, price thresholds like $100 silver weren't endpoints. They were simply numbers that paper markets passed through on the way to true price discovery. The appropriate response was to maintain positions, add strategically on any pullbacks, and absolutely avoid panic selling. Historical examples supported this analysis. From 2008 to 2011, gold climbed from $700 to $1,900. At every $100 increment, analysts called the top. Yet the metal kept climbing because the fundamental driver, currency debasement, continued unabated. Those who sold at $1,000 gold, thinking they'd gotten out at the top, watched in frustration as it nearly doubled from there. But Schectman emphasized something crucial. The setup in 2026 was different from even that powerful 2008-2011 run. That rally had been driven partly by Western investors rediscovering gold as inflation protection. This time, the drivers were sovereign nations competing for finite resources in an increasingly fractured world order. The shift from globalism to mercantilism changed everything. When nations prioritized their own interests over global cooperation, resources became weapons. Countries that controlled critical materials, rare earths, copper, silver, gold, oil, gained tremendous leverage. Silver occupied a unique position in this new paradigm. It was simultaneously a monetary metal and an industrial necessity. Solar panels, electronics, weapon systems, medical devices. Modern technology couldn't function without silver. Yet, unlike copper or rare earths, silver was also money. It couldn't be printed or easily substituted. This dual nature meant silver faced demand from two completely different buyer categories. Industrial users needed it for production. Investors wanted it for wealth preservation. When both groups competed for limited supply simultaneously, the price discovery process could move shockingly fast. Schectman's decision matrix didn't provide easy answers. It required investors to honestly assess which scenario matched current reality. And it required the discipline to act on that assessment, even when it contradicted conventional wisdom. The hardest part wasn't making the decision. The hardest part was making it before the threshold was reached. Because once silver hit $100, emotion would override analysis. Fear and greed would cloud judgment. The investors who would profit most weren't the ones with the best timing. They were the ones who had made their decisions in advance, documented their reasoning, and committed to following their plan regardless of how they felt in the moment. Understanding the right decision meant nothing without the courage and framework to execute it. This was where most investors failed, not from lack of knowledge, but from lack of preparation when the critical moment arrived. Andy Schectman had witnessed this pattern repeatedly over 3 decades. Intelligent people who understood the fundamentals would still make emotional decisions at exactly the wrong time. They would panic, sell at bottoms, or chase prices at tops, not because they were foolish, but because they hadn't built decision-making systems that removed emotion from the equation. The key to navigating threshold moments like $100 silver wasn't intelligence or market timing. It was systematic preparation. Schectman's implementation framework began long before any price target was reached. The worst time to decide what to do at $100 silver was when silver actually hit 100. By then, adrenaline and fear would be coursing through every investor's veins. News headlines would be screaming contradictory messages. Financial advisors would be calling clients with urgent recommendations. In that chaos, rational decision-making became nearly impossible. Instead, investors needed to establish their decision triggers in advance. If physical premiums contracted below a certain threshold, that triggered one response. If delivery times shortened, that suggested another path. If sovereign buying slowed, it demanded reassessment. These triggers had to be documented and specific, not vague intentions like I'll sell if it feels toppy, but concrete metrics. If premiums drop below 5% and delivery requests decline for 2 consecutive months, I will reduce my position by 25%. The documentation served a critical purpose. When emotion tried to override strategy, investors could return to their written framework and remember the logic they'd developed during calmer moments. Position sizing rules formed the second layer of preparation. Most investors approached precious metals as all or nothing propositions. They were either fully invested or completely out. This binary thinking guaranteed poor execution. Professional investors understood scaling. They built positions gradually when accumulating and reduced positions in stages when distributing. This approach reduced risk and prevented the catastrophic mistake of selling everything right before a major move or buying everything at a temporary top. Schectman recommended establishing clear allocation targets in advance. For someone with substantial wealth, precious metals might represent 25% of total assets during normal times. But what should that allocation become during a monetary crisis? 40%? 50%? Having that answer documented before crisis arrived meant investors could rebalance systematically rather than reactively. If metals rallied and suddenly represented 60% of a portfolio, the predetermined rule might be to reduce back to 50% target, taking some profits while maintaining substantial exposure. The 72-hour observation window was critical for threshold moments. When silver crossed $100 or gold breached $5,000, Schectman advised a deliberate pause. Not paralysis, but intentional observation. During those 72 hours, investors should monitor specific indicators. Were physical premiums spiking or contracting? Were delivery requests accelerating or slowing? Were refineries reporting increased orders or cancellations? Was mainstream media suddenly promoting precious metals or dismissing them? These data points revealed whether a threshold crossing represented a blow-off top driven by speculation or a genuine structural shift toward price discovery. The 72-hour window allowed the initial volatility to settle and patterns to emerge. Critically, this observation period wasn't about waiting for perfect information. Perfect information never arrived. It was about collecting enough data points to determine which predetermined scenario was unfolding, distribution or accumulation. Post-threshold management required equal discipline. Once a decision was made, whether to hold, add, or reduce positions, implementation had to be staged. Market orders during volatile periods generated terrible execution. Limit orders placed at specific price levels ensured better fills and prevented chasing. For those adding to positions after a threshold crossing, dollar cost averaging over weeks rather than days smoothed out volatility. For those reducing positions, selling into strength over multiple transactions captured better average prices than dumping everything in one trade. Risk management protocols protected against catastrophic errors. Even the most well-researched strategy could be wrong. Stop-loss levels, predetermined exit points, and maximum allocation limits prevented any single decision from destroying a portfolio. But Schectman emphasized distinguishing between tactical threshold responses and strategic generational positioning. Trading around $100 silver was a tactical exercise. Building wealth across decades required strategic thinking that transcended any single price level. His mentor, Richard Russell, had taught him a profound lesson. Real wealth wasn't built by perfectly timing market tops and bottoms. It was built by following the primary trend, the major force shaping asset values over years and decades. In the 2020s, that primary trend was currency debasement. Every major government was running unsustainable deficits, financed through money creation. Mathematical reality dictated that this couldn't continue indefinitely without destroying currency purchasing power. Investors who understood this didn't need to trade around every price fluctuation. They could maintain core positions in hard assets regardless of short-term volatility, knowing the long-term trend was firmly in their favor. Schectman's personal approach reflected this philosophy. He had been buying precious metals every 2 weeks for 36 years, regardless of price. When silver was $5, he bought. When it hit $50 in 2011, he bought. When it crashed back to $12, he bought. Now, approaching $100, he was still buying. This wasn't stubbornness. It was strategic recognition that no one could perfectly time markets, but everyone could capture the benefit of a multi-decade trend through consistent accumulation. For those just beginning to build positions, the same principle applied. Waiting for the perfect entry point meant never entering. Markets didn't accommodate perfection. They rewarded participation. The final element of implementation was accountability. Investors needed to document not just their strategies, but their actual decisions and outcomes. When did they buy? At what prices? Why did they make each decision? This record served two purposes. First, it revealed patterns in decision-making, both successful instincts and recurring mistakes. Second, it provided invaluable data for refining strategies over time. Schectman noted that the greatest risk at major thresholds wasn't making a wrong decision. It was making no decision at all, or making emotional decisions that contradicted carefully developed plans. Paralysis at critical moments meant missing opportunities that might not recur for years or decades. Emotional reactions meant abandoning sound strategy exactly when discipline mattered most. The investors who succeeded through threshold moments were not the smartest or the ones with the most sophisticated analysis. They were the ones who had done the unglamorous work of preparation, documenting strategies, establishing triggers, building systematic processes, long before the excitement of $100 silver arrived. When that moment came, they didn't need to figure out what to do. They already knew. Their decision had been made weeks or months earlier, written down and committed to. All that remained was execution. This was the difference between professional investors and amateurs. Professionals made decisions based on systems developed during calm periods. Amateurs made decisions based on emotions experienced during volatile periods. And in the precious metals markets of 2026, that difference determined who built generational wealth and who became a cautionary tale about the dangers of following the crowd at exactly the wrong moment. The strategic framework was complete. The decision matrix was clear. The implementation process was defined. Now came the hardest part. The discipline to follow through when every instinct screamed to abandon the plan. That discipline couldn't be bought or borrowed. It had to be built, one decision at a time, over years of consistent practice. And for those who developed it, the rewards extended far beyond any single market or asset class. They learned to trust themselves, to think independently, to make decisions based on evidence rather than emotion. These were skills that transformed not just portfolios, but lives.